Big deficits and a big debt make it harder for governments to use taxpayers' money on things that matter the most, like healthcare and education. Our level of deficit and debt also affects our credit rating. So what exactly is a credit rating, and how is Ontario doing? Now, most of us are familiar with credit scores, right? They're a way to signal to banks, landlords, credit card companies that someone is trustworthy and responsible when it comes to paying the bills. A higher credit score means bills are paid on time and in full, while a lower score indicates there's trouble. Well, a credit rating is like a credit score, only for governments and businesses. A credit rating predicts the ability to pay back debts or their likelihood to default. One of the key indicators that influence how rating agencies evaluate institutions is the net debt to GDP ratio. This number compares the level of government debt, the net debt, to the gross domestic product, the GDP, or how much the economy actually is producing. Over the past 15 years, the previous government increased Ontario's net debt to GDP ratio from 27% all the way up to 38%. Through the work of the Independent Financial Commission of Inquiry, we now know our real net debt to GDP is closer to 40.5% for 2018-19. Ontario currently has a AA rating. It has been 27 years since Ontario has had a coveted AAA credit rating. Our government set a long-term goal of restoring the province's AAA credit rating to get Ontario back on track.